Hey everybody, how are you doing? Happy Monday morning to you. I'm joining you from North Carolina, and I do hope your Monday is starting well wherever you are. So, welcome back to the Biotech Capital Compass. This is another edition of our video podcast. And I'm going to be going through just very quickly some of the highlights on what we've been writing over the last couple of weeks, and just synopsize those for you. Slightly more in-depth analysis of what we've written is in the body of this newsletter. So feel free to peruse that also with the hopefully quick video podcast that I'm here providing for you. So today we're talking about a little bit about biotech's next act. We've been actually talking about this literally since last October when we started publishing the Biotech Capital Compass. And our thesis has been, and we've done a lot of analysis around it, is that biotech is probably towards the end of its 4 to 5 year drawdown. There's some fundamental let's say, analysis that we've done. We've looked at, indices analysis, the overall earnings power of the entire sector, a lot of other analyses that leads us to believe that the sector is essentially in the last sort of couple of innings of its drawdown, and that, some of the positive share price performance over the last essentially year to date for biotech is actually the sector and investors anticipating that biotech might be hitting a bottom. We saw a similar trend in 2000, 2001, 2002. We've published on that previously. We saw a similar trend in 2008 through 2014, where the drawdown was slightly longer than this one. We're getting close to that one, the length of that one. But even there, we saw that when fundamental factors were getting better, even though the sector seemed to still be in a funk in terms of capital raising, jobs, meaning people getting let go, less people getting hired, but the share price, the stock market is always forward looking, was already starting to work, quote unquote, work in terms of biotech overall as a sector. And as investors were anticipating that the sector was getting, close to sort of turning around and getting to positive territory again. And that's kind of what happened in 2000, 2002, and again in 2008 through 2014. So we called it the biotech inflection point. We've done a lot of analysis on it, published literally 4 or 5 notes on it over the last I would say 10 months. So you should go back and read those. Subscribe to our newsletter if you want to read the analysis in depth. Specifically in our September 2nd note, it's called Biotech in Transition: Signs of a Turn. We flagged early signs of recovery. The Nasdaq biotechnology sector, it's posted double-digit gains in the third quarter. Valuations, though, remain at the low end of history, and believe it or not, earnings expectations for the entire sector have turned positive for 2025. So this is something that we look at through Bloomberg, where it rolls up all the earnings of the sector. And up till, over the last few years, the earnings for the sector as a whole had been negative. Now they've just turned positive over the last earnings call. And if you think about it, maybe that makes sense, right? Because most of the companies that are cash burnings or the ones that failed have essentially been removed from the index. And so the ones that are staying, that are larger caps, are profitable. They continue to grow earnings. And then you have more companies, that are launching products that are becoming profitable. We're starting to highlight those companies more in our newsletter. And then also a lot of the companies that were just burning cash and weren't meant to succeed have essentially been taken out. So, price to earnings, that's a multiple. So if you look at the denominator earnings, you've got more stronger companies there. And so, it's the earnings should become positive, and price earnings multiples should start looking good also going forward. Now, does that mean biotech might actually make money? Let's just pump the brakes. There's still, you can always still go lower. But I think it is interesting that the sector as a whole, is expected to have positive earnings this year. Not by much, about $4 to $5, but that could turn into $40 to $60 next year. Wall Street analysts are almost universally bullish on the sector, which is either a vote of confidence or set up for disappointment, depending on your temperament. So again, we're still in that in-between stage. I would not get too pulled up now, but I do think that, for the longer term investor, the moments like these are nice little signposts that seem to be occurring. Let's talk a little bit about the XBI ETF, which actually, if you buy that, you have exposure more to small and mid caps versus the IBB ETF. And the XBI, there seems to be a short squeeze setup. Even I was a little bit taken aback when I looked at it this weekend. I was just doing some quick work on the various ETFs, and it seems like the XBI ETF is under siege. Short term is at all-time highs. And the short interest ratio is at a 5-year peak. S3 Analytics, which is a firm that displays their data through Bloomberg, gives it a 98 out of 100 on our squeeze risk. Translation, if the right catalyst hits, we could see some very unhappy short sellers scrambling for the exits. Now, I would say, this positioning reflects how bearish institutions remain on the sector, especially short-term catalyst-oriented investors. So those are the ones, mostly hedge funds, that are shorting the sector, and they seem to be very bearish. So again, this is there's a pro argument, there's a con argument. This is probably one of them. But I do think for the longer-term investors, these volatile stretches could present opportunities to steadily build positions, assuming, of course, biotech continues to deliver on its underlying performance. A company called Ater, they just had a phase 3 miss reported today. I think the stock is down 80+%. This is exactly the volatility of biotech showing through. We've written on this a couple of times, and a couple of newsletters over the last 6 months. And it is sad that the phase 3 trial for efzofitimod failed to meet its primary endpoint. There were folks, and we cited them, that were pretty skeptical of the phase 3 working. The placebo patients did unusually well. Over 40% came off steroids, making it tough for the drug to show separation. So the experimental arm of the drug efzofitimod versus placebo, if placebo is doing really well, that makes it much harder for the experimental arm, to really separate from the placebo arm. If the placebo arm is doing better than what historically it had been demonstrated to do. For investor, that means near-term case is broken, though the science might still live to fight another day. Again, really tough for that company. I'm not one of those investors that likes it when companies fail in biotech. I worked for a hedge fund for 5 years. It was actually one of my least anticipated events was when a trial didn't work out, because what that meant was it was good for the folks that did the analysis and saw it coming. And during my hedge fund days, I had been short many companies, and luckily I was right on more than I was wrong. But I will say I don't think it is fun. It was never fun for me, because that means that people are going to lose their jobs. Patients won't see the promise of a new drug. But hopefully, a lot of the work that Ater did will help future drug development efforts in these lung-associated disorders. Let's talk about a couple of large caps. Vertex, it's a bellwether under pressure. This large cap bellwether is facing growing pains. The cystic fibrosis franchise remains a cash-generating machine, projected to grow by a third in 2030. By 2030, the pipeline setbacks recently over the last year, from pain drug miss to a trial pause in their cystic fibrosis franchise using mRNA, have kept pressure on the stock. The fundamentals look steady, yet sentiment has soured. For long-term investors, that disconnect might be an opportunity if management executes. Companies like Vertex, where essentially what you've had is multiple compression. In our newsletters, we demonstrate that sales and earnings for the company have stayed pretty steady, have come down a little bit, 5-10%. But really, the stock being down that much over the last year really tells us that the multiple, which is a measurement, of sentiment and expectations for growth going forward, that's really compressed. If management keeps executing over the last year, which they have a really good history of doing, over the next year, I do believe that the multiple will expand again, which I think is what longer-term investors, really look for, those sort of setups where they want management that has an execution-oriented history to really deliver that again. Regeneron, we call that stability versus setbacks. This is a company where their eczema product Dupixent, that's also in asthma and COPD, is powering ahead. Seems like it's going to be a $20 billion plus biologic before it's all said and done, which is really amazing. Maybe only it's going to be probably the second largest biologic to like Merck's Keytruda, the PD-1. But that has tremendous amount of competition with other PD-1s and PD-L1s. Dupixent is really the only drug still in eczema that is off that, if its size and revenue, its competition is slowly building. So Dupixent is powering ahead for Regeneron, but Eylea continues to erode faster than the company would like. This is their eye drug, lots of competition for biosimilars and from other branded products. The high-dose version of this drug was supposed to help, that was launched a few years ago, but uptake has lagged. The transition from their legacy products to the lower dose version of Eylea to high dose has probably taken a lot of Regeneron investors by surprise. So until this transition and this growth in the overall Eylea franchise, the legacy product plus high dose, until that stabilizes, the stock is unlikely to regain its premium multiple. And that's mostly because Eylea is, I believe something like 40+% of sales, but it's 60-70% of profits. It's the most profitable, commercial project for Regeneron. And because it's compressing, it's reducing profitabilities, which is why investors are not reacting to this well, even though the other products seem to be doing, really well. The pipeline is strong, but execution remains a sticking point here. So, we're probably more bullish on Vertex at this point than Regeneron. But again, I would keep a very close eye on Regeneron. I think that in the next earnings calls, whether it's the third quarter or, healthcare conferences in January or their fourth quarter call in late January, early February, if they start saying that Eylea has stabilized and maybe even start gaining market share back again, which historically the commercial team there has been able to deliver, I would imagine that the stock reacts really favorably to that. So in closing, where does this leave us? Biotech is compressed. There's a lot of skepticism, especially from institutions and hedge funds. But maybe, just maybe, I would say biotech could be turning the corner. The next few quarters will tell us whether this is the start of a durable re-rating or just another head fake. So stay tuned. Thank you for always listening to us. And for those our paying members, thank you for subscribing. Even our free members, thank you for looking and listening in and paying attention to what we're saying. This is really a labor of love for me. So I do appreciate each and every one of you that gives us a shout out in one way or another. Take care. Until the next time, talk soon.